From the morning reading, new highs on the IWM, the spiders, the diamonds, XLF and XLY. Steel stocks pause. Costco gaps up. Breadth weakened compared to the prior session as advancers led 1881 to 1155 on the New York Stock Exchange and led 1878 to 910 on the Nasdaq. Oil futures were up $1.15 to close at $50.96, forming a tweezer bottom bullish candle pattern and a bull flag price setup. On the S&P 500 snapshot, the Trump rally continues at a slower pace. The rally in equities continued, although at a slower pace than the prior day's surge. The benchmark S&P 500 traded in a narrow range around yesterday's close through most of the morning. The liftoff began during the lunch hour and carried the index to a 0.41% intraday high around 2 p.m. An hour of selling followed that took the S&P 500 to a lower range prior to its 0.22% gain at the final bell, yet another record close. With only 11 market days until Christmas, we should perhaps view this rally as attributable to the team of Trump and Santa. The sell-off in Treasuries resumed today with a yield on the 10-year note closing at 2.40%, up 6 basis points from the previous close. Despite the push to new highs, too many stocks are lagging. Within the S&P 500, fewer than 70% of the stocks are trading above their 50-day averages, and also fewer than 70% are above their 200-day averages. That's an unusually small number given the S&P has pushed to multi-year highs. Over the past 3 weeks, there have been 5 of these divergences, the most since the year 2000. About those new highs, they surged again. On Thursday, more than 1,000 securities trading on the New York Stock Exchange and Nasdaq exchanges exceeded a 52-week high, the most in more than 5 years. They accounted for more than 18% of all issues, one of the largest percentages in more than 30 years. That's usually a sign of short to medium-term exhaustion. The VIX rose again, as noted yesterday. When the VIX rises despite a gain in the S&P 500, it is an atypical market behavior that has consistently led to a decline in stocks over the next 1 to 2 weeks. The last time the VIX rose 3% on back-to-back days, when the S&P rose both days, was February 27, 2012, after which the S&P lost 2% a little over a week later. Adding to short-term concerns is seasonality. Stocks have tended to peak on the 5th trading day of December, showing weakness through the 11th or 12th day. That's when the vaunted Santa Claus rally typically emerges. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 5:48 a.m. Mountain Time, and I am recording this in preparation for the market day of December the 9th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And at the time of this cut, all 4 of the U.S. broad-based indices were just above scratch. Crude oil was up about 1/3%. Bonds were down about 0.5%. Euro was down about 0.5%, and gold was down also about 0.5%. China up about 0.5%, Hong Kong down almost 0.5%, Japan up about 1.25%, Germany up about 0.25%, as is the United Kingdom. In terms of macroeconomic reports for today, of note for the United States, you have the University of Michigan Consumer Sentiment. That will occur during market hours. You also, in terms of current volatility, things have been ticking up. You heard mentioned by one of the morning authors that we've had 2 days in a row an atypical behavior where the market's been up, but also volatility has gone up. So really quite strange. You see short-term VIX almost a 13 at this point, though skew is benign. IV percentiles are very, very low. with the S&P at a 6, the Russell at a 12, the Nasdaq at a 7, and the Dow at an 11. We did have a standard deviation size move put in yesterday by the Russell, and that is the 4th one standard deviation size move in a row. The Russell has been on an absolute tear of late. In terms of the charts, let's go ahead and go over there. Okay, the S&P futures, and you see yesterday a new closing and all-time high for the S&P futures. Thus far today, we had a little bit of a gap down at the open, but is slightly positive at this time. And you see this really sharp move. So we had the sharp move on the post-election period, a bull flag coming back down to resistance, now turned support, and then the bull flag move coming up, exploding out of that move, and then perhaps the most bullish activity occurring just a couple days ago when we not only broke this area, but we did it on huge volume and really significant 2 standard deviation size move. If that's not enough of a bullish move for you, you then had yesterday's follow through. So very, very sharp move. Since on the 5th, so that would be Monday. Since Monday, we've gone on the futures market from 2178 to 2251. That is, about 80 points in 4 days. A pretty amazing range from top to bottom there. And you have to wonder if we might be setting ourselves up for some sort of at least temporary exhaustion. Now, things have been very much strongly bullish, and certainly if anybody has been short in this, they have just been getting clobbered. And, if you were one of those people who bought in to the conventional wisdom that the market was going to drop some 5% if Trump were to win, you are really hurting, because that would have had you down here below 2,000, and here you are now looking at 2251, some 250 points away from where the conventional wisdom would have had you about this time. So that's about 10%. So not only are you not only down 5%, but you're up about 5% in that relatively short period of time. So this is probably got some people wrong-sided, and part of this move, especially here in the last few days, is probably being powered by people that are capitulating on their shorts and just frankly in disbelief that the market would be so bullish on the results of the election. And then in terms of the Dow, just the same thing. It didn't even worry about a bull flag retracement pattern or a pullback to prior resistance. It just powered straight up. Also, frankly, probably needing to have a bit of an exhale. Remember, the market can't just inhale forever. It needs to exhale. And certainly the Dow is in tune for a period of exhale coming up. The Russell, especially, is particularly crazy. 15 straight up days, followed by the bull flag, and then off it went to the races again. So 3 indices that are just on fire and about as bullish as you could ever be for something as broad-based as an indice. Now, the Nasdaq's been a different story, and after a significant sideways ranging action, we have cleared the top of the cloud in recent sessions, and then certainly we've gone from some 4,700 to about 4,869, up about 170 Nasdaq points in this week's trading action. With that being said, we're still just up near the tops of the range and up near the area of resistance, which has certainly proven to be very difficult for the Nasdaq to overcome, unlike the other indices. Now, part of this has been the behavior of the FANGs, and you see they have improved, but here you have Google still below the cloud, Facebook still below the cloud, Amazon still below the cloud. You know, these are big cap, major contributors to the Nasdaq numbers and so forth. And when you there have so much relative weakness, it's very difficult for the overall Nasdaq to take on. Let's go ahead and take a look at some other markets. And you got crude oil that's also been dealing with its own wall of resistance. And despite a couple pokes, including one earlier this week, has failed to close above that area of resistance. We'll see if it can get through that. And you would expect that that resistance holds until proven otherwise, but usually with repeated pokes at that area of resistance, you start to erode away at that wall of resistance. And at some point, I suspect that this is going to go through and break up out of this range. Now, the dollar, of course, has been part of this, and you see the dollar has moved strongly in the last couple days and is set up from a complex bull flag pattern, perhaps diagonal, well, probably best described as a bull flag pattern, and is probably setting up at this point for a diagonal breakout. Short-term pattern is kind of messy, but bottom line is that if we come up here and go up over the 102.12, that certainly would be a setup for an extension pattern. With the dollar up, of course, that has implications for other markets, and you see gold continues to have weakness. It's had something of a sideways consolidation pattern for most of this week, but nothing here to tell you that this is about to reverse trend. This continues to look very bearish on the intermediate term. In terms of bonds also looking very weak and has been in somewhat of a sideways pattern, but also looks to be in a continuation pattern to the downside. And volatility. Volatility has been ticking up the last couple days and kind of against a pattern of normal when the equities are going up. But let's also put this in context. This is a minor atypical pattern, given that the level of the volatility at this point is in this very low range. And in fact, some of this was in the 11 handle, but certainly everything that's within the 12 to 15 handle is what we normally consider normal bull market range. And we don't get too excited about movement anywhere within that 12 to 15 area. Now, when things start to tick up over 15, we start to pay increasing attention. And of course, when you get up over 18, we are quite aware of what volatility is doing. So these are kind of minor cautionary things, the atypical behavior going on, and especially given and part of what's probably going on here is people are starting to buy increasing protection, recognizing that the S&P, Dow, and Russell have just been absolutely parabolic in their moves in the last some 4 weeks now. And given that 4-week time frame, we've moved several percentage points in most of those indices. That there would be a retracement coming becomes increasingly problematic for the bulls and of higher probability for the bears. So now the size of that pullback at this point would be expected to be relatively small. And in fact, let's go ahead and go over to the daily report. We currently are in this market phase for these price patterns near resistance or extension type patterns. So kind of keep that in mind. That certainly is bullish, though. There's nothing to be concerned about. In terms of the 3 market timing signals, the first one from IBDs and confirmed uptrend. The second one is the Gmi Index. It's a perfect 6 out of 6 and 8 out of 8. That buy signal has been in place since 11:10. So both of those signals are as bullish as they can be. It is the third one, which frankly is more defined in that it gives us multiple markets and it gives us multiple time frames that has been giving us some trouble, though we are at this point universally bullish on the short term. we have majority bullish signals on the intermediate term with 5 out of 8 of the signals, and then long term we're 4 out of 8, so mixed signals. So we're needing to see this continue to improve. It certainly is on the path, but overall consensus is certainly bullish. But in terms of healthy bull, we still haven't gotten that, series of higher highs and higher lows and a true trending type move. Now, we certainly have had a couple significant higher highs and a higher low in the most recent pattern, and that certainly is reflected in the short into the intermediate term. But we're still needing to see that more mature trending market pattern to develop. So until we get that, we'll likely remain somewhat conservative. In terms of position sizing opinions, though, both those models are coming in at 100%. Intermediate term market posture just about as strong as it could be. All 4 indices in the severely strong bull camp, and that's all supported by a strong bullish sentiment line. In terms of the hedge warning status, we remain at 0+, normal with some elevated conditions. Remember, keep in mind that level 0, that is a strong, healthy, bull, trending market. We've not had that condition, but very rarely in the last 2 years. We've been mostly range bound. So this 0+ has been about as low as the hedge warning level has gotten in quite some time. If we do return to a 2013 type scenario, that's where you would see a level 0. In terms of strategy opinions, no change in these opinions. We've been basically the same opinions now for a couple of weeks. All 3 opinions give permission to initiate new positions, while somewhat defensive still in the orientation on the cover call strategies. I think I suggested yesterday perhaps sprinkling in some positions with a 2-to-1 ratio of in the money versus out of the money strikes. And that 2 being on out of the money strikes. I should make that clear. In terms of specific warnings, you had this kind of atypical situation going on that the morning author also was talking about, where volatility has been increasing of late, even though the equity market's been going up, and that's shown up actually and triggered a couple of these volatility type warnings. We also had the volatility ratio warning fire off its signal with yesterday's close. Along with that, you have a high distribution day count on the Nasdaq, though we will recognize that this has been ebbing down. It's gone from about 9 in recent sessions, now down to 6. Once it gets below 5, that will go off of warning status. In the trend-based area, those are all in good shape, and you look at the New York Stock Exchange new high, new low indicator for the 1-month period, 868 coming in on the bull side versus only 32 on the bear side. So very, very strong action there. Now, in terms of the intermarket risk aversion indicator, we have had 4 of these go to risk off in recent sessions, though I will say that they just barely have crossed. So this is a relatively weak signal at this point, very little angle or separation to those indicators. Sentiment, a little bit high on stocks, both short and intermediate term, and you see the fear and greed index up in the extreme greed area at an 85. Another sign that we are certainly should be looking for signs of exhaustion, signs of reversal. Now, it can stay extended for extended periods of time, so we don't just simply load up with shorts just because we have an extreme sentiment score. What we do instead is that we become sensitive to watching for the signs of reversal, like candlestick reversal patterns. Now, in terms of breadth, yesterday was a pretty strong day with basically just telecom, consumer staples, and industrials, kind of a mixed bag in terms of risk on, risk off, being negative yesterday. And I think some of these numbers that you heard referred to by the morning authors as to, in terms of breadth, the number of 52-week highs versus the amount of participation across the entire indices, is a reference to really what's going on in terms of an extreme sector, industry, and stock rotation that has been going on in the last 4 weeks. So we've had, in effect, the election winners, those companies that would be expected to do better in a Republican-dominated legislature and presidency, that have had huge moves, and then those that would be expected to not fare so well have had, quite a bit of capital move out. So this has not been the typical broad-based move where everybody has been lifted. This has been a huge sector rotation, giving rise to an overall higher indice with a subset that has been responsible for that big move up at the expense of money moving out of other areas. So the sector rotation component to this rise is certainly a big part of this story, and you have to understand that when you start talking about breadth and so forth. In terms of intermediate, all 3 time frame market postures, you see that sector rotation continue to show that some weakness in consumer staples, healthcare, and utilities. So, we start to see improvement in some of these sectors that have been beaten up in the initial sector rotation. Healthcare is still down, has been the subject of a number of tweets and so forth from the president-elect. That sector continues to be a sector that doesn't have very many friends in the media or in politics, no matter which side of the aisle you sit on. In terms of percent change, we see some consistency starting to come in, especially on those high-performing sectors, such as financials, such as energy, and perhaps even for industrials, where just about all the time frames have gone smartly green, and indeed 3-month performances, and especially 1-month performance. Basically, this is now reflecting most of what's happened since the election. If you go back now a month, basically this is your sector rotation, where utilities, healthcare, consumer staples, kind of gave it up, and that money then rotated into industrials, telecom, consumer discretionary, materials, financials especially, all benefiting in this post-election period. Okay, that should be enough for today. Let's go ahead and wrap this up. And I will scroll through these. If you see something of interest, just hit the pause button. Also, you can go to the hyperlink that's indicated there, and that'll give you additional information. If you are a short-term trader of any sort, I have to say this is probably one of the best bargains ever out there. 8 different markets in terms of daily price guides, all the various trader levels, all lined up in a very efficient information packet that's emailed out to you before the market opens each day. That's only $25 a month, so you might want to check that out. Disclaimers, as always, hit the pause button to review the disclaimers. And then also down here at the bottom, note the hyperlink for the full set of disclosures. We'll be back here for Monday's session next with the Falcon Global Market Preview. In the meantime, manage that risk profile each and every day. And then, of course, also seek to learn something about your trading craft every trading session. Good trading.